In today's YouTube video, we're going to go over the 3 fastest ways that you can grow a small account in 2024. And every single one of these I actually personally have tried myself over the last 8 years. And so we're going to start with what I started with first in my journey, and then we will end with what I am currently doing. And in my opinion, is one of the best ways to grow a small account in 2024. However, before you skip right to number 3, I do think it's very important that you understand each of these 3 because everyone's different. So everyone has a different trading personality, lifestyle, strategies they gravitate towards, different personality traits, and that can all play a big factor in which one you might stick with and actually have success with. And speaking of, I do have a free quiz linked down below in the description box that will match your personality traits and your lifestyle and all your daily habits with what trading strategy might fit you best. And so after this video, I think that'd be a really cool bonus for you to go take that quiz and see what advice it gives you and see if it lines up with what you chose based on this video. And before we even dive into small account strategy number 1, I need everyone to be on the same page on why it's so important to get around something called the PDT Rule. So the PDT rule stands for pattern day trader, and what it means is it's a limitation put on traders that you are only allowed to make 3 day trades in a span of 5 business days. If you do anything over that, you will be flagged as a pattern day trader, meaning that you need to have 25,000 or over in your account to continue day trading. Now, there are definitely ways around this rule. That is what this entire YouTube video is about. But first, I just want to make sure you fully understand the rule and how this can be really damaging to your psychology as a trader, especially if you're just starting out, is it can cause you to make a ton of trades based off of fear or FOMO, due to not really having many chances based off of the PDT rule to take trades that you might see that are good or A+, and you actually might end up holding on to losers, letting green trades turn red for the fear of using a day trade. So for example, let's say that you have this big runner that you jumped in on Monday and you're up really big and you decided that you did not want to take profits and you wanted to swing trade it, but you swing trade it into Tuesday and you lose all of your gains by Tuesday morning. Now this can start to develop that fear that you have to take those profits immediately, and if you don't, you might lose them. And this can cause you to hesitate on trades or just feel a lot of fear and FOMO, fear of missing out, around your trades based off of that PDT rule. And that brings me to strategy number 1 with small account trading, and that is swing trading. So for the entirety of this video, I'm going to assume that when you have a small account, you have $1,000 in your trading account. Now, some of you may have way less than that, and don't worry, number 3, there actually is a way that you can day trade with way less, starting at around $50. But on average, from what I've seen over the years, most traders, when they are quote unquote saying that they are trading with a small account, they are starting with about $1,000. I specifically gravitated towards swing trading penny stocks. And if I say penny stock, it typically is anything $10 and under. And so the reason for this is pretty obvious. If you have a smaller account, then it's going to be very difficult to buy larger cap stocks and actually make headway with it. And so I gravitated towards the cheaper ones because I was able to buy more shares. And oftentimes, if you can find low float, high volatility runners, you can get a little bit lucky. I will say it's a lot of luck just based off of timing and how the market's reacting to that sector at the time period you're trying to trade them. What I mean by that is, let's say that you were pre-GameStop and AMC, which I believe off the top of my head was 2020, don't hold me to that, but it's been a few years now. If you were at that time period or before, penny stocks used to run all the time. There were tons of opportunity. However, over the years, especially after GameStop and AMC, there had seemed to be a big slowdown on penny stocks running like they used to, meaning less opportunities daily or even weekly. But that does not mean that swing trading stocks and or penny stocks is completely dead. You can definitely still make money. It's just going to be a slower process. So let's dive into the charts, and I'm going to show you an example of a swing trade that we actually just took not too long ago. A very simple trade. We saw a nice trend break off of a previous demand zone and support level. and we were looking for buyers to be there just like they were previously. So as long as we held between 240 to 250 support, looking for buys once trend broke, risking that level, and then just looking to sell at previous resistance, which you can see we had some nice previous resistance right in the 290 to 288 area. So this range right here would have been a great place to look to take profits. And so let's just hypothetically speaking, say that you had a $1,000 account. Now you're actually not even able to use margin, which is what you're definitely going to want to use as a margin account if you're stock trading. You cannot use a margin account technically until you're over $2,000. And a very quick Google search can confirm that for you with multiple different brokers, between Fidelity, between Charles Schwab, Robinhood. It is pretty common across the board that you need at least $2,000 to take advantage of margin, which is basically just giving you more buying power. So that means that you just have $1,000 to play with. And what you don't want to do is go all in on a position with that entire $1,000, because you have no wiggle room to dollar cost average if that's your strategy. And if the play goes against you, you're automatically at a huge disadvantage because you used all of your capital. So let's just say, hypothetically speaking, you wanted to buy at least 300 shares of Fubo. So 300 shares, and you took it right at trend break. So let's say that you took it at like 257 times 257 means that you're going to be spending about $771 on that position. That only leaves you about $229 left out of your 1,000. So not much room for error at all. So with that, you really should have a tight stop loss. So 771 is what it costs you to get in this trade. If you were at 257 and you put that much money in that trade, I would definitely be looking to risk, very, very tight risk here. Probably no more than, let's see, no more than 10 cents. I would risk no more than 10 cents. So risking 247, entry 257. With that being said, your target was near 280 to 290, okay? So 57 to 87 is going to be 30 cents, and then you're risking 10. That's a good 1 to 3 risk versus reward ratio, meaning you're risking 10 cents to make 30. And so that is a good risk versus reward. And if you're risking that much, you really need to make sure you are getting a 1 to 3 or better. Okay, so you had 300 shares, right? And you ended up selling near the top, which is definitely not reasonable to expect every time. But let's just say for simple math purposes, you sold at 287 from 257 entry. So that is a 30-cent gain on 300 shares, meaning you made $90. So $90 on a $771 investment, that's pretty dang good, especially if you're just starting out. And if you can do that consistently, it could also beat out some typical gains that you'd see from just long-term traditional investing, which is like 7 to 8% year over year on just investing in something like SPY. So it's definitely not something to knock, and it is an easier, more beginner-friendly way for somebody who's brand new to start out. It's how I started. We're talking about the pros and cons of something like this. I would say the pros, again, it's very beginner-friendly and an easy way to enter into trading because it is one of the more easier things to learn to do, and it's typically straightforward, right? I would say a con of it would be that you do need more capital than the other two that we're going to go over. So it does require more money, which is definitely not an advantage if you're just new to the stock market and you're just trying to get your feet wet. You definitely don't want to have to put too much of your own capital up because there is a high chance that you're going to lose a lot of it. It's just the reality of being a trader. You have to endure some losses to learn some lessons, and then you eventually get better over time. So the goal is to start with as little amount of money as possible so you're not risking very much to learn. And you can obviously paper trade, which is the best way to start, but many people, including myself, are stubborn and skip that. And that's just me being honest. I tell people all the time to paper trade, but I was one of those stubborn ones who did it. However, that led me to losing a crap ton of money when I first started. So I kind of did that to myself there because I knew better and I did it anyways. All right, so let's move into strategy number 2 for growing a small account. And strategy number 2 is going to be options trading. So this is typically what I see most people go from stock trading into options trading, and that's exactly what I did. It is one of the most difficult things to learn when it comes to trading, in my opinion, and it is the hardest thing to do in trading because there are so many variables involved. You have got things like Greeks, aka theta, which can decay your premiums even without the stock or ETF moving. And if you have no idea what I'm talking about, just know that it makes trading more difficult. It also makes it more difficult for you to set a hard stop and just let that play or trade play out in your favor. You have to be very quick, especially if you're trading short-term expiration dates. But options trading can be very, very lucrative, and you can absolutely grow a small account with options trading. I myself, over the years, have grown many accounts from 1,000 to 5,000, and even 1,000 to 10,000. It is possible, but let me tell you, it is freaking stressful and it is very risky. So you can easily blow an $1,000 account options trading within a day or two, depending on how risky you are being. For the sake of this options example, we're going to use SPY just because that's something I used to trade options on all the time. And options, the simplest way to put it, are like a little leveraged contract that you can buy on larger cap names like SPY, which is an ETF that tracks overall market conditions. Tesla, Nvidia, Apple, all of those have option contracts. And so you can use a small amount of money to place either call or put bets on those different stocks, is the simplest way to put it. So let's do a SPY example. Let's say that you were trading SPY. Let's go to 5 day, 5 minute. You were trading SPY this past week on the 26th. And calls means that you are betting that the stock is going to go up in value. Puts means that you are betting the stock is going to go down in value. So let's just do a really quick technical analysis draw right here. We got a nice little trend line wedge forming. Let's just say that you took calls right here, which is a great entry if you caught it. But again, this is just an example to show you how this works. And you definitely do not need to use anything close to size on that $1,000 to make a difference. Again, leverage. You were trading the 126 date. Now you need to go to the trade tab. This is on Thinkorswim. And now you're gonna look at the option chain. So this is where options have tons of different variables. You have a lot of decisions to make. You gotta choose what strike price, what expiration date, call or put, all of these different things you have to take in consideration. So again, they're more difficult to trade. And I'm on oil right now. Let me go to SPY. And there is the option chain for SPY. Sorry about that. But let's say that it was the 26th, and so you were trading the 29th contracts. So we click these, and let's go look at some calls. So calls are gonna be on the left here. You see that right here. You don't want to go too far out of the money. Again, if you're brand new to options trading, please go look up an entire tutorial on how to trade options if this is how you decide to go about your small account strategy and trading. There's a lot that goes into learning options, and today is not a course on how to trade them. It's just giving you a simple rundown so you can make the decision for yourself. So let's say that you were trading, let's just go 487 here, and we're gonna chart out the 487 calls. So I'm gonna bring this over, clear this up real quick, and then we're gonna look at the timing that you were looking to buy. So let's say you were looking to buy around 1025. Contracts at 1025 were around $1.50. So what this means is if you had a $1,000 account, you definitely don't need a ton of money, like I said a million times. Let's say that you were only going to use $300 out of that $1,000. And if contracts were $1.50, aka 150 per, so you've got 150 per contract. How did I get that? Is because 100 shares equals one contract. 100 times $1.50 equals 150. Again, if you don't know what I'm talking about, after this video, go look up an options trading tutorial. $150 for one call contract. That's all you need to know here, right? Because you were looking to buy off of this break, so you bought one option contract for $150. Let's say you wanted to scale it up and you wanted to go big and you bought two options contracts. That would cost you $300. So 2 option contracts, you're in this trade for $300. So that's much cheaper than the Fubo trade because that one cost you $771 to get into. So you have a lot more leverage and a lot more opportunity to buy things cheaper with options. Is again the simplified way to put this. So those contracts went all the way up to over $2, even hit a high of like $2.20. So let's say that you went from $150 and you sold these at, let's just say $180. There's no way you held through all of that. So what that means is now you've got 2 contracts worth $180. So 180 times 2 means that you've got $360. And remember, your initial cost was $300, okay? So you made $60 off of a $300 investment, which is really good, okay? Trading is all percentage based. If you want to do the percentage math on that, you can definitely take the time to do so. But the whole point here is options allows you to trade with a small amount of money because they are so leveraged, but they are very volatile, risky, and complicated. Now, the reason I say they're risky is because if you did not take profits on these contracts and you let them go all the way back down, you would not only have lost your initial investment, but you would be negative. So a green trade would have turned to a red trade because of theta. The beautiful theta means that options will decay even if we're hovering at the price that we bought it at. You can see we ended up coming back right here to where we bought it at on the stock chart, but those option contracts were still down and negative at that point, and that is due to theta. So one thing I need you guys to understand if you decide to go strategy number 2, which is options trading, is you need to have a cash account, not a margin account, because you can day trade with whatever cash is settled. So meaning if you took a $300 trade out of a $1,000 account, you now have $700 left over that day to day trade with, and then the cash will settle that you have used within 24 hours. So my camera completely died on me and I do not have my extra battery. So we are going to switch over to the computer camera to wrap up the strategy number 3, which is my absolute favorite and what I am currently doing in 2024. It's actually the reason I completely dropped options trading altogether, and I am solely focused on number 3, which is futures trading. Now, I have a full workshop that's completely free, 2024 futures trading, that explains everything that you guys might be curious on in regards to the exact brokers I use, what prop firms I use, trading strategies, how much money you need. All of those things are covered in that free workshop, and I will link it down below. But just to cover some quick pros versus cons here on why I chose futures trading. So first being, there is absolutely no PDT rule when it comes to futures. So regardless if you go a self-funded account route, meaning you put money in it yourself, like you might have traditionally done over the years with other strategies like options or stocks, or prop firms. So prop firms are basically something you can try out for, and they will fund your account for you and give you money to trade with as long as you can prove you know how to trade. So regardless of which one you do, there are ways to start with small amounts of money, and there's no PDT rule. So meaning you do not have to have $25,000 to day trade. There are less variables to trade. So you have no Greeks, no theta like you would with options. They're very liquid and volatile. So remember with stocks and penny stocks, I said that there might not be opportunities every single day, which can hinder you in the long run, especially if you're looking to make daily profit off of this or replace your 9-to-5 job. There are opportunities every single day when it comes to futures trading. You can trade at 23 hours a day. They are really flexible when it comes to trading hours, where options you can't trade until after market open. You can trade stocks in pre-market, but it's more difficult. Futures trading, you can absolutely trade before market opens, and that's mostly what I do. And you guys already know why they're small account friendly, because you do not have a PDT rule involved in futures trading. There are high margin requirements on TOS, which stands for Thinkorswim or TD Ameritrade. The reason I bring this up is because some of your traditional brokers might not allow you to trade futures or require tons of money. That is definitely not the case as long as you are trading with a futures friendly trading broker, and I go over my 2 favorite in the futures trader workshop. But you can start with as little as $50 for minis and $500 for micros. If you don't know what that means, just again go watch the entire futures workshop. I don't want to make this video too long explaining all the details, but you can definitely get around this with the right broker. They can be risky with leverage. So just like options have leverage and can be risky, so can futures. This is actually one of the pros of using a prop firm versus your own money, because you are only risking what you are paying for the prop firm challenge, which limits your risk a ton. This is a pro and con. They're very liquid and move fast. You have opportunities all the time because they are very liquid 23 hours a day. However, if you're brand new to trading in general, you really need to make sure you take the time to paper trade and practice with fake money until you fully get used to how fast they move and how fast they are traded, because that can cause, number 4, you to lose money quickly, which is like that with anything in trading. If you are trading something leveraged and volatile and you don't have a trading strategy in place and you don't have proper risk management, you can absolutely lose money quickly. Again, going back to the prop firm and why I like them is because the only thing you're risking is what you put in, and those are very small amounts of money considering that most prop firm challenges with coupons are around $30 to $50. And the last con here is they're extra volatile with news. So if you're trading in pre-market, make sure you're not trading any type of news drop, which is typically 8:30 a.m. Eastern. You will definitely get hurt. Your stop might not execute, and tons of prop firms don't allow you to trade alongside news. So I just recommend avoiding that altogether. By far takes the cake, home runner for me is going to be futures trading. I am absolutely obsessed with futures. There are no Greeks, there are no extra variables that options have, but it still gives you the opportunity for leverage. So just to give you guys an example on money involved here, because I know you're probably wondering that, if you go and try out for a $50,000 evaluation account, using a prop firm, it can cost you on average about $50. So if you pass, you're spending $50 of risk to access $50,000 in capital, which on a $50,000 account, you can easily make $200, $300, $400 per day without taking tons of trades. And so I have members in the group doing it all the time. So when it comes to where I wish I would have started in the beginning of my journey, I wish I knew about prop firms and futures trading. It would have saved me a ton of money and a ton of headache, because trading is about how can you get the most experience with risking the littlest amount of money, and how can you get around that stupid PDT rule that causes you to make bad decisions in the long run. And futures for me solved all of that and more. So once again, if you guys are interested in attending that free futures workshop, I linked it down below along with that free quiz I mentioned earlier. Hope you guys enjoyed this video. If you did, make sure to give it a thumbs up. And with that being said, I'll see you next time.